Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Getting Started with Options. And today, I wanted to talk about our really sincere desire to never be wrong, or maybe the trader's motivation to just be as right as possible, as frequently as possible. And this can be a real motivation for so many would-be social media influencers out there trying to attract an audience, or somebody out there trying to sell a program. They really like to project, I'm successful on my trades 85% of the time, 90% of the time. Well, I wanted to talk about what they may not be telling us about those high probability trades. We can set up a trade that has 90% probability of success, but I want to weigh the potential advantages of that sort of approach against also the risks. So today is going to be all about understanding, the other side of the equation of the high probability approach to trading. We're actually going to be placing an example trade today. A lot to cover. Really looking forward to this one. But before we can get to any of that, though, we first of all say hello to everybody already chatting in out in YouTube land. Great to see so many familiar names as always. Hello there, Marcus and Eva, Josh, Kevin, Frank, Jack, Lola, Rick, everybody else. Thanks for joining us week after week. We always appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream has concluded, enjoy the presentation, but be aware that you are invited to join us here in the live stream. If you'd like to be here, this is a Tuesday webcast series. We kick things off promptly noon Eastern time. We really would love to have you here as a live stream audience member. And to assist here with our live stream audience members, my very good friend Connie Hill is going to be hanging out in the chats. Connie's going to be addressing any questions that I can't get to just during the flow of the presentation. Connie and I have now been working together for more than 20 years. So Connie, thanks for having my back. And Connie and I would also like to issue an invitation to everybody watching. If you have an account on that platform known as X, you should be following your favorite presenters there. It's the best place to connect with us in between these live streams. You can find Connie on X at Connie Hill CS. You can find me there at Cameron May CS. But let's get into this discussion. What they might not be telling us about those high probability trade scenarios. Now, as we get into this discussion, risk is real. We need to be aware of that. That's the point of this discussion. So bear these important disclosures in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only. It should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. And investing involves risks, including the loss of principal. All right. So what are we going to be talking about today? Let's set an agenda. 3 things that I want to do. First of all, let's take a look at the market, see what's happening there. Then we're going to plan an example high probability trade within the context of today's market conditions. We're going to be using an example stock, and we're going to be walking through how those probabilities can actually be calculated in advance. Then we're going to place that trade. But as we do, we're going to weigh not just the pros of this sort of an approach, but also make ourselves very aware of the risks associated with this high probability, lots of wins style of trading. So let's go right to the Thinkorswim desktop trading software platform. This can be downloaded free of charge from within your Schwab Online account. If you're not familiar with Thinkorswim, you can find it under the Trade tab. But in any case, here's the S&P 500, and it just keeps going. Yeah, the S&P, look at this, down a shade today, 0.13%, but trading just off all-time highs from yesterday. So yeah, little bit of red there, but really since April, we've been storming higher. So let's say that our trader, with that as a backdrop, is maybe planning on placing a bullish trade. Now, market conditions can certainly change on a dime. Maybe there's some new event that causes investors to become less bullish and start selling. But let's say that our trader is looking out. Maybe they're planning to place an option trade out here for August 15th. And they've decided, well, if the general flow of prices seems to be bullish, maybe we'll just go in that direction and just hope that things persist. That's a pretty common approach with a technical approach to trading. The trader might just assess the current direction of markets. Sometimes I might do a little bit more in-depth analysis of what's happening here. In this case, though, trading right at all-time highs, it's not difficult for me to make a bullish argument, at least up to this point. Eva, thank you for answering my question. So Eva's referring now to a question that I posted on X about, is there anybody out there that feels like this might be a little bit bubbly? Could we be at a turning point? Interesting. Yeah, that was interesting to see how people feel about that, Eva. But in any case, let's say that our hypothetical investor just thinks that things are likely to continue higher, but recognizing that they might be wrong, maybe they prefer instead to go for a bullish trade, but that has a large capacity for timing issues. Even if stocks come down to a decent extent, this trade might still be in position to make its maximum profit. So we're going to be doing a bull put vertical spread in this discussion, but we're going to be structuring it specifically to have a high probability of success. And I'm going to be targeting trying to get this to be as close to 90% chance of making its maximum theoretical gain as we can get it. So let's use an example stock here. Now, as I go to the stock, and today's example trade is going to be built on JP Morgan Chase. Why did I choose JP Morgan Chase? Well, for some traders, there can be considerations like price per share can play a role when we're trading options. Price per share on higher price stocks can lead to more expensive options trades. It can also lead to larger obligations when selling options short, which is what we're going to be doing in this. It's going to include a short position. But also those higher priced stocks can have maybe more options to choose from. So there are pros and cons that might lead a trader to choose a stock of a specific price. Also, traders might put a heavy emphasis on liquidity. Illiquid stocks tend to have illiquid options, and that can lead to difficulty getting into and out of the trade, make it harder to trade profitably. But let's look at a third potential consideration among many others. And that is what's happening with the stock chart. For those that are more technically oriented in the planning and placing of their trades, they may want to look to see, does the stock appear to be behaving bullishly, and does it seem to imply potential for continued bullishness? So with JP Morgan Chase, yeah, just like so many other stocks in the markets, it's been heading higher and higher and higher. Recently, it broke through a previous high from February, and that old price ceiling has recently demonstrated itself, at least so far, as an effective price floor. Came down and bounced off that 280 level. Now, for about a week and a half here, prices really bounced back and forth between that 280 level and about 290. But just over the last few days, we've started pushing higher again. So maybe our technically oriented trader here has looked at the S&P 500 and they're bullish. Maybe they've looked at a stock like JP Morgan and they see breaking through price ceilings. Maybe we have support levels below the entry. And we're going to go ahead with that trade. Now, Tatiana says, is volatility on JP Morgan too low? That's a good question. Volatility is closely related to the pricing of options. And when volatility conditions are lower, what that can cause us to do with setting up our vertical spread is we may have to move that vertical spread closer to the current price. If we're too far away from the current price, there may not be any interest in those options. And for the trader seeking to collect a credit, maybe there's just not much of a credit available at those more distant strike prices. But, Tatiana, the trade-off there is if the stock continues to be relatively calm, maybe that prevents a strong likelihood of this high probability trade failing. So there are pros and cons. So too low, I think, is a little bit of a squishy term. Some traders may actually prefer trading these sorts of strategies in low volatility environments on low volatility stocks. Others, though, may like the higher volatility and the more distant premiums that can be sold as a result. So great question there. But in any case, let's set up our trade. Here's what I'm going to do, first of all. since probability is the driver of today's discussion, let's go set up a bull put vertical spread with around a 90%. Doesn't that sound, man, if I put that on the title of the video, here's a trading strategy with a 90% probability of success. Do you think that would get some eyeballs on it? Probably would. But a lot of those people, if we came and watched the video, wouldn't understand the associated risks. So we need to be aware of those. But let's go to our trade tab. And I'm going to go out here to the 15th of August expiration. And I'm going to use delta as our guide for probability. Delta can serve a couple of potential purposes for the would-be option trader. Number one is the delta can tell us how much an option would make or lose in its value if the stock rose or fell $1. Now, another thing that it can do is it can tell us the probability of a contract expiring in the money. Now, if we're going to be selling options, typically an option seller wants a contract to expire out of the money. So let's look at our delta column over here. And if I look at, you know what, this one's going to be close enough. I'm going to use the round number ones. It just tends to make the math easier for those that are learning these concepts. So let's stick with maybe this 275 contract with about a 13. It was a 13 just a moment ago. Now it's 14. What does that 14 mean? Well, there's about a 14% chance that this contract will expire in the money and retain some value at expiration. In other words, there's an 86% chance that this contract is just going to expire out of the money. And for the would-be seller here, that means there's about an 86% chance that they are in position to realize their maximum theoretical gain if they were to sell this contract. So let's do the 275. And as we do that, I'm going to put that on the chart here. Let's draw in a line at 275. Let's see. Here's today's candle. We're going to go down just below 275. And I'm going to draw in a line right there and carry it on through to expiration. There we go. Right about there. That'll work. Now that's going to be half of our trade. The other half of the trade, let's go maybe $10 wide. Let's go down to the 265 put. And we're going to be buying that one. On the chart, that's going to be down here. I'm going to draw in a line at 265. There we are. Get that as close as I can. That's close enough. But in any case, those two lines represent this trade that we're setting up. And this trade is going to be structured so that as long as we're up here somewhere above 275, as we hit that August 15th expiration, this trade is going to be in position to achieve its maximum theoretical gain. If you look at where it is right now, it could even fall if it's up there close to 295, 293. There's about $20, $18 of wiggle room if our timing is just awful. If this trader gets it completely wrong, even if the stock goes down, if it goes down through this floor, if it goes down to this floor, even if it goes down through that, as long as we're above 275, this trade's going to be in position for maximum theoretical gain. So let's map it all out. In our left column, you know I like to do this. This is our example trade. I like to see the numbers. Do you guys like to see the numbers? You like it when I write this out? This is a short put vertical or spread. Where Nini says, can you sell or exit this trade before expiration? Yes, a trader can, but there can be potential problems associated with doing that. I want to illustrate that because yes, the trader usually can, assuming there's good liquidity and we can actually get the order filled, because liquidity is a concern with options trading. But yes, in any case, here's our short put spread that we're structuring here. We're going to sell the 15th of August. We've decided on the 275, and I'm keeping an eye on this, see if I want to adjust it at all, but I don't think I will. Yeah, it's hanging around there about 13 on the delta. We're going to sell the 15th of August 275 put, and that looks like that's trading between 120 and 124, so I'm going to call that a $1.22 that we might be able to pull in as a credit. And at the same time, we're going to buy the 15th of August 265 put. And that looks like that's trading between 120 and 124, so I'm going to call that a $1.22 that we might be able to pull in as a credit. And at the same time, we're going to buy the 15th of August 265 put. 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 And that looks like that's going to cost us between 59, 61 cents. We'll call it 60 cents. There we go. So this trade, as currently constructed, we can use our delta right here and assign it a probability of success or failure. What's the probability that if we put this on and let it run to expiration, that the trade works out just as we planned, and we can start to build up the bragging rights of being correct a high percentage of the time? Well, the delta here is at 13. So as of this moment, there's an 87% probability of achieving our maximum gain. What's the probability of incurring our maximum loss if the trader is just trying to avoid being completely wrong? Well, in this case, the 265 has a delta of just 6. That means only 6 times in 100. Only 6% of the time, if we put on a trade like this, would it mathematically be expected to have its maximum loss. So doesn't that just sound like a great trade? 87% chance that we make all the profits we're planning. Only a 6% chance that we're exposed to the worst case scenario. So almost, I have to always qualify it with almost. It feels like it's almost guaranteed to work. Almost guaranteed to not fail. That's not a guarantee. These probabilities allow for the fact that, yes, this could fail, but we'll probably succeed. I can say that with a high degree of confidence to the point of about 87%. So this is the sort of thing, if I'm just out there trying to get social media clout, I might just really promote this. So I'm right 87% of the time, and I could probably state that with this sort of an approach. Over time, it's probably going to work out to be close to that. But we need to talk about the mathematical realities of this sort of scenario. So let's just visit what these contracts represent. As attractive as these percentages look, let's talk about what we're getting ourselves into. So we're receiving theoretically a premium of $1.22. Somebody's paying us $122, but in exchange, they have the right to sell shares to us for $275. No matter how far, if that stock collapses in value, we have a contractual obligation here to buy shares for $275. Well, as we look at our chart, those shares right now are worth $293 and currently strengthening in value. Even if someone has the contractual right to sell those shares to us for $275, are they likely to do it right now? Probably not. They could if they wanted to, just highly unlikely because, hey, you'd be underselling it to us by $18.50. If those shares collapsed in value, that's when they would have the motivation to do that, right? Now, what do we get for this 60 cents that we've spent? $60 that we on. Josh is saying, why not go even wider on the strikes to increase this premium? That's a good question, Josh. Maybe if time permits, let's look at that. Let's experiment with tweaking this trade scenario a little bit. But for now, let's say that we spend the 60 cents, the $60. What does that deliver to us? In this case, that gives us sort of a mostly offsetting contract. This allows us to, if we get stuck with those shares at $275, we can unload those shares for no less than $265. We have the contractual right to sell those shares for the same duration of time for $265. It's not that we actually want to buy shares at $275 and sell them for $265, but this is just trying to stop the bleed or limit the damage, not stop the bleeding, but limit the damage if we happen to be wrong on this trade. So what are we left with net out of this? If we collect $122, spend $60, setting commissions aside, that leaves us with a net credit, which is also the theoretical maximum gain of this trade of 62 cents or $62 per contract. Now, I realize that doesn't sound like a lot, but actually as a percentage potential return, it's still considerable. But 62 cents doesn't sound like a lot. Well, we're not tying up a ton of money in this trade. And just remember, there is an 87% probability that this is exactly what we wind up with at expiration 24 days from now. So before we get too dismayed by this pretty small potential return, let's calculate how much we're committing to this trade. What's the maximum theoretical loss? This is the net cost of the trade, or that's not the right way to put it. It's just the theoretical maximum loss. How much could we lose if we get stuck with shares for $275? Other party decides to exercise their right to sell shares to us for $275, and then we turn around and sell those same shares for $265. Isn't that a $10 loss? Yes. But we did get 62 cents to set this deal up in the first place. So that leaves us with a net risk exposure of $9.38 on this trade right now, as we just saw those numbers in real time. So we're tying up $938 in pursuit of $62. And if you're looking at this correctly, you're probably thinking, wait a minute, Cameron, so you're telling me if this thing fails, I can lose $938? And if it works, I can make $62? Yeah, that's the reality of high probability approaches to trading when using options. Now, what I would really love for somebody to show me, I've thrown out this challenge for years, never had a taker on this challenge. Show me a strategy where there is a high probability of success, where there is more return than risk, and that's the strategy I'm going to use for the rest of my life. But it doesn't exist in options trading, not that I've encountered, even with a single exception. Maybe somebody can find that single exception for me. But there's a teeter-totter effect with options. When the probability of success goes up, the reward for being successful goes down. Now, there's another thing. As the probability for failure goes down, the risk for encountering failure goes up. There's those two teeter-totter effects with options. And we could rebuild this as many times as we want. I've done this many times in the past, and it just always comes out this way, at least in the ones that I've done so far, and at least in the ones that I've investigated in my own approaches. Yep. When you watch these webcasts being recorded live, I didn't price JPM's options today, but I knew this was how it was going to work out. So what gets lost in the shuffle when somebody says, hey, I have a trading strategy using options that has an extremely high probability of success, the reward to risk tends to get diminished in those discussions. Now, I don't want this to come across as an argument for the dismissal of these kinds of approaches. No, what I'm saying is if a trader is considering this, they need to consider all of the variables of the strategy and be comfortable with all of those before proceeding. So what does this work out to be? I want to do some other quick math here. 62 cents. I said it doesn't sound like a lot, but we're not really tying up that much money. $938. Well, if we come up here to our calculator, if we have $62 that the trader might make and divide that by the $938 being committed to the trade, that's about a 6.6% potential return in 24 days. Now, that's actually a very high rate of return in the grand scheme of things. Trader would not typically expect to make on not a normal strategy. This is fairly normal actually for this sort of an approach. But on other types of market approaches, that's a very high potential return. But at what cost? Well, this is what we need to recognize. There is the potential for losing $938. So Rocco says, can we show the analyzed graph? Yes, we can, Rocco. However, I also like to put this on my chart for quick future reference. So I've already drawn in this nice comforting green box that tells us, well, if we're up in this area, we should be in position to make our 62 cents. Where might we lose the 938? Well, that would be if we fell down here. If we finished at expiration somewhere down in this area, let's edit the properties of that, turn that to a nice pink box. This is our no-fly zone. Now, the nice thing is we can see that we are quite a distance from that, and there really isn't that much time to get to that level. But just to discuss what would very likely happen if prices were to fall. Let's say we got a huge move down from $293. Let's say we dropped down below the 265. We wound up at 260. So we fell about 33 bucks in 24 days. Is that likely to happen? No, it's actually not likely to happen at all. There's a very slim chance that happens. But if it did, let's say our stock is down here at 260 and someone has the right to sell us shares for 275. Oh, yeah. Are they going to do it? Yeah, almost certainly. Maybe somebody gets a wild hair and says, I don't want to sell the stocks for way more than they're worth, but at expiration, we better just plan on being assigned those shares at 275. And if the choice is then, well, do we just keep the shares at 275 and they're only worth 260? Pardon me. Do we keep the shares that are only worth 260 bucks or do we sell them for 265? Yeah. In that case, we probably just exercise our right. As a matter of fact, if we get to expiration, it happens automatically. Buy the shares at 275, sell for 265. That is our $10 loss, and the 62 cents is small consolation, leaving us with $938 of loss. So that is what can happen if this falls. So before we go and look at this, before we build this trade and we analyze it on the Analyze tab, I want to talk about the relative likelihood of this, not just in numerical terms. John says, can you give us an example of something like this where the price of the security is under $100? Maybe I'll do that next time, John. I probably wouldn't have the time to build that trade and do it any justice today. But in any case, it's easy to look at this and say, yeah, but come on, it's not going to fall $33 or actually it would only take $28 to get down to our maximum loss here. But let's just call it 30 bucks. If this stock fell $30, what does that do for our trade? Well, it might feel like that isn't going to happen, but has it happened in the past? If we just look over the last 12 months for JPM, there was a $25 sell-off right there. There was a $25 sell-off right there. Here's another $25 sell-off right here. And then there are $30 sell-offs right there and right there and right there. So over the course of the last 12 months, this has actually happened 6 times. And so before we launch this discussion, I wanted to talk about how this trade could go bad, how it could be really bad, and how it could be disastrous, where we just have our maximum loss. So bad might be if we fell like $25 and we wound up down in between the two strikes, where we're not all the way to maximum loss, but we've incurred most of the loss. Well, that's happened 6 times, right? Really bad is if we fell $30 and we got down below our strike. That's happened 3 times. So 3 times in the last 12 months. Now, disastrous would be if we fell $30 and then also we're down $30 at expiration. So we've already seen these examples of this stock falling 6 times. And I did that to illustrate that this sort of thing can happen. But now I want to put ourselves in the shoes of what if we did a similar trade to what we're doing right now, and we just started basically a month before expiration and carried it right to expiration. So right here. So for example, you notice we're right past this last expiration, just past this last expiration. What are the odds that we are both down $30 and we hit expiration? Well, if we had done a trade like this here, let's see where we wound up at expiration. We wound up there. How would that trade have worked out? That would have actually been a profitable trade. Almost certainly. What if we did this one here? Well, here we fell. Notice it included a $25 drop, but stock went up, stock went down, and at expiration, this still would have been at a maximum theoretical gain scenario. What about this one? Now that one worked out. What about this one? That one worked out. What about this one? That went down. It included a $25 drop from top to bottom, but as long as our timing wasn't just as bad as possible, this really only net dropped from about 245 down to about 238. That was net a $7 drop over this sort of a time frame. What about this one? That one worked out. What about this one? And there is definitely a lesson to be had here. It looks like we wound up this one about right there. So that one raced up, pulled back, still worked fine. What about this one? This one, let's say we started at the worst part of the day up here. And where did we wind up? Did this one fail? We went from 265 down 241. That's a $24 move down net at expiration. A $24 move down net at expiration here would have us right in between our strikes. In that case, we'd very likely be sold the shares, but our long contract just expires worthless, and the trader may just wind up owning shares if we allow this contract to get to expiration. I think that's the only example where we fell far enough net. So the lesson here is that with these sorts of high probability approaches, the trader might also want to make sure that they are prepared to be patient. Because even though there were 6 really not good moves, by expiration, 5 of those 6 had recovered and were still in position for a maximum gain scenario. John says, so Cameron, the reason you don't do a call spread is you'd have to buy the high above the high price. But John, no, today I want to take one side of the equation. I could have done this with call spreads. It would have worked out almost exactly the same because in reality, now this is a good point here. Let me go to our Trader Talks YouTube channel. So by the way, if you haven't subscribed to our Trader Talks channel, make sure that you've done that. You can go down and click on the subscribe button right now. It only takes a second. It doesn't cost anything. But this is where we house our previous webcasts. Not every single webcast is added to our playlist, but the vast majority are. And one thing that you can do is if let's say you have that question, well, should I do a credit spread or a debit spread? Well, I'll bet one of our coaches has done a comparison of the two strategies. Let's just do credit, debit, put them both in the keyword search here. And what do you know? Here's our options vertical showdown. Trade a credit or a debit spread? Because John asked, why aren't we doing calls instead of puts here? Here's a huge spoiler alert. They're very close to identical strategies. Not entirely identical, but really, really close. If we're talking about trading on the same stock at the same time with the same expiration with the same strike selection. So if I set up a bull put spread and a bull call spread on the same stock at the same time and compare them, their probabilities are going to line up very closely. Their reward and risk scenarios are going to line up very closely. Their break-even points are going to line up very closely. There's very little distinction between the two, with a couple of exceptions. So if you want to see what those exceptions are, make sure that you watch that webcast. But in any case, great question there. But the history lesson that I wanted to take away from this part of the discussion is that these trades are high probability as long as the trader doesn't tinker with them. This has an 87% chance from day one. But if the trader starts to mess around with that, like for example, let's say we took the trade here and the stock's going up and we're feeling great. The stock collapses. Uh-oh, get out. That almost certainly ended at a loss, only to recover. And we would have been in maximum theoretical gain position. Or if we did a similar thing, let's see if we can find another one. Yeah, this one here. Trade's going okay. It starts to really struggle, but then we recover. Did I draw my, yeah, there was a big white candle there right before expiration. This one very likely worked out just fine if it were structured similarly to what we're doing today, if the trader didn't take any other action on its way to expiration. Lola says, is this trade set up for higher probabilities? Is your intention to let the probabilities play out and not stop out? Yep, that is the probability. That doesn't mean that that's the only potential approach. For some high probability traders, they will still put in a stop. But for others, they see the probability, they're okay with the probability, also okay with the fact that if the stock starts to falter, they may just wait to see if it recovers. If it doesn't, could result in assignment, or it could result in maximum loss. Now, here's the other thing. Here's another thing, not the other thing. It's not that there's only one or two considerations with these sorts of trades, but we could have a whole string of maximum gain scenarios. How many times can the trader afford to be completely wrong? Let me do some quick math here. 938 divided by 62 is 15. In other words, if we made 62 bucks on 15 trades in a row, we were just right. Time after time after time. Tell me, would that be a pretty good win-loss ratio? If somebody had a YouTube video that says, I'm right 15 out of 16 times, that sounds amazing. Well, after 15 similar trades to this one, the trader might be up 938 or 930 bucks, and then they're finally wrong just once, and they lose $938. That is one of the realities of these high probability scenarios. And there is no guarantee that the trade we're about to place isn't this one straight out of the gates. There's no guarantee that we're going to get 15 in the bag before we have that big loss. So the trader better be quite confident, because the cost for being wrong in these sorts of high probability scenarios is steep. Right. But let's go ahead with our trade here today. I'm going to go to the trade tab. Let's put it together. Let's analyze it, because I said I would. So we're going to looking at the 275, 265. Here's a relatively quick way to place these sorts of trades when the strikes are multiple strikes apart. Just hold down the control key on the keyboard. So I'm going to hold down the control key. I'm going to click on the option that I intended to sell, the 275. And then I'm going to go back up to the chain, the options chain. And while holding down the control key, I'm going to click on the ask price for the contract that I intended to buy. There we go. That creates that vertical spread with our intended strikes. And it looks like that credit's still hanging around there at about 60 cents, although the natural is closer to 57 cents. I don't know if we're going to quite get what we were originally planning. Why has the credit shrunk? Well, because the stock is probably going in the intended direction here. So let's look at this. Frank says, how likely will somebody take your trade? I don't have any idea. Frank, one thing that I should say is these are always for demonstration purposes only. This is never a promotion for a specific trade or a trade strategy. These are always for educational purposes only. But in this case, before the trader submits a trade, if they want to see the profit and loss and probability scenarios displayed neatly on a chart without having to draw in all the lines like I always do, we can right-click on that trade and just analyze it. And we're going to go to the risk profile. So this takes us to our analyze page. I'm going to click on the risk profile. And what we're seeing here now, let me just make sure I don't have any other trades on this. I know I don't. Anyway, what we're seeing here now is a profit and loss scenario breakdown. Now, the red line is the one that I want to focus on for purposes of this discussion. This red line is telling us how much we might make, how much we might lose at different price levels. So we have over here our potential profits and losses on the vertical axis of our chart. Across the horizontal axis, this is the x-axis of the chart, we can see theoretical price levels. Now we can start to ask ourselves questions. Let me just hit a quick, let me set this back to, no, that's okay. I'm not going to worry about that. Anyway, what this is showing us is that let's assume that price is, above 270 at expiration, 280, 290, 300, 310, doesn't matter. This red line is showing us that would be our maximum gain scenario. You can see that intersects with a profit, a small profit, but a profit. With the way that we've currently constructed this, with a 59-cent credit, $59, we can see if we point it like, let's say 280, what number do we see in red down here? About a $59 profit. If we're up at 290, $59 profit. If we're at 300, $59 profit. What if the stock starts to slip and we wind up down at 260? Well, $941 loss. If we have a $59 credit on a $10 wide spread, that's going to leave $9.41 of risk. $941 of risk here. So really anywhere below our lower strike of 265, we see that we hit our maximum loss. Now, I in the past have definitely expressed, I have some reticence. I'm hesitant to frequently show this chart, because when a trader really understands their strategy, they should have this little chart in their head. They should know, okay, so with the way that I've structured this, if I'm below 265, I must be at my maximum loss. If I'm above 275, I must be at maximum gain, or in position for those at expiration. And this is just allowing us to see it. But it almost sounds like I'm asking a lot, but really for those who have traded these strategies for a decent length of time, they don't really need this analyze tab anymore. It's nice to see it, but it's telling us what we already know. It's kind of like when we if we say, hey, what's 5 times 4? We know it's 20. And then we punch it into a calculator and it says 20. Well, I already knew that. So to me, this is kind of like the calculator that shows us the potential trade outcomes. But if we already knew them, we didn't need them shown to us. I don't have any problem with using it. And where it really gets valuable is when there are multiple trades, 2, 3, 4 things going on at the same time. And we can see a profit and loss layout for multiple strategies. That's where even a more veteran trader can really start to struggle. But yeah, if the trader feels like they need to see this on the chart, that's great. But maybe they need to spend more time also really understanding the strategy. Okay, but there we go. Let's place this trade. So my apologies. I think it was Josh that was asking about maybe changing our strikes. I'm not going to do it today. We don't have time. But let's go ahead and place our trade. And let's see if we can get a 60-cent credit. We were talking about 62 cents. Doesn't look like that's going to be very likely at this moment. Let's try for 60 cents. That would leave $940 of risk per contract. And so how about we keep this under our typical $4,000 threshold? Let's do 4 contracts. 1, 2, 3, 4. There we go. So I'm going to click confirm and send. We're going to sell these verticals, trying for a 60-cent credit at $940 per contract risk. That's $3,760 of risk, $240 of reward potential, minus a commission of $5.20. Send that order off. And we're in actually for 61 cents, so really close to what we talked about. But guys, we've addressed something that I think is very important, and that is really understanding what doesn't always get mentioned with these high probability trades. That is the risk of the trade. When the probability goes up, the reward potential goes down when trading vertical spreads. When the probability of loss decreases, the risk when losing goes up. All right. So everybody, I hope you've enjoyed this discussion. This is what we do in these sorts of webcasts. Beauty at its best says, can you show how to set a stop to exit the trade if the stock reaches the put price to reduce the risk? I won't be doing that in this webcast because it would take me an extra several minutes, and I have to clear the way to allow the next presenter to use the channel. But we do that on a fairly regular basis in the webcast series. So you may want to go check out some of the archives. But in any case, guys, I hope that you'll put it in your calendar to join me again next Tuesday for another discussion of getting started with options. I have other webcast series that run throughout the week, so I'll look for you in those other webcasts. But just make sure that you have subscribed to our Trader Talks channel. This is where you can find the playlist. So the name of the channel is Trader Talks Schwab Coaching Webcast. You can subscribe by clicking the button down in the lower right-hand corner. It only takes a second, doesn't cost anything. But you can find our playlists here. You can do keyword searches here. If you're looking for this webcast series, click on playlist and go right down to the bottom. It's going to be the second row from the bottom. There it is, getting started with options. Barb filled in for me recently, so that's why her face is on there. Also, make sure that you're following Connie and me on X. Best place to connect with us in between these live streams. As a matter of fact, just this morning, I was on X. I've sent out a couple of new posts, but I've also been replying back to people who have replied to some of my posts. So, for example, just before the webcast launched, I had a question about retail spending. We keep beating forecasts even with persistent inflation. What do you think? Is the American consumer stronger than many thought? Or are they just maxing out their credit or building debt? I'd like to see what people have to say on that topic. But in any case, great resource there for additional learning. Best place to connect us when a live stream isn't live, which is most of the week for me. Connie, thanks for helping out in chats. I didn't catch a survey. Sometimes there are surveys, so fill those out when those are presented. Thank you to everybody who's already clicked the thumbs up or the like button. I can see 155 people watching. 61 have already clicked like. Thank you for doing that. It shows appreciation. It also gives a boost to our webcast in the YouTube algorithm, helps more people understand things like what are the risks associated with high probability trading to go along with the theoretical benefits of the trade. All right, everybody, I'll see you next week. I'll see you in a future webcast this week. I'll also look for on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.